As this slide says, my name's Rob. It says Head of International Trade there. It says Head of International Affairs in your schedule. I'm actually Head of External Trade, so, but I'll answer to all three. What I'm going to cover today is mainly around the tariffs, WTO schedule, no-deal tariff, trade continuity agreements, so some of those questions that Ed raised earlier on about Chile, South Africa, those kind of areas for imports and for exports, and then tariff rate quotas, also known as TRQs. So, and as we've mentioned previously, some of the text might be a little bit small on the screen, but we'll have the slides around to you. So the government have lodged the new schedules with the WTO, and they basically replicate the EU's schedules for tariffs. So that means that the bound rate of the tariffs, which is the ceiling, so the point at which the tariffs can go no higher than, is the same as the current applied rate for the tariffs. So if you're paying 13 euros per hectolitre on wine tariffs at the moment, that cannot go above that tariff as an applied rate. It might come below that, as we'll talk about in a moment, but that is the kind of the ceiling level. If there is a deal struck between the UK and the EU, and that is ratified, then those tariffs will continue to apply because we will continue, for sake of argument, to be a member of the EU until the end of the implementation period in 2020, after which we will apply our new tariffs. That's in the event of a deal. So the current tariffs would still continue to apply on wines coming in for both bulk and bottled. There would be no tariffs on spirits, with the exception of some rums, where there's currently tariffs, as David mentioned earlier, on bulk rum to protect some of the French protected origin rums. And there's also currently a tariff on US whiskey, which is there in retaliation to the steel and aluminium dispute. So that's currently about 25% on whiskies entering the EU. But moving beyond the WTO schedules, and if there is to be a no-deal exit from the EU, the government, HMRC and DIT have published the Day 1 no-deal tariff schedule. So this removes tariffs on approximately 87% of all goods coming into the UK. It helps to smooth the transition and any disruption to trade in that period. So on imports, on wine imports for a period of approximately 12 months, there would be a move to 0% tariff. So instead of paying your kind of 9 to 11p per bottle, or whatever the fixed exchange rate works out at that particular point, that would move to 0. So you would no longer be paying your 13 euros per hectolitre, 15 euros per hectolitre. That would go to 0%. That would keep a constant state of trade for most. So for wines entering from the EU, you don't currently pay a tariff. As Ed mentioned earlier on, for Chile, you don't currently pay any tariff under the free trade agreement. For South Africa, quite a bit of wine comes in under the tariff rate quota, tariff free, so that would mean that all South African wine would come in at 0%, but also for Argentinian wine, Australian wine, New Zealand wine, US, and from wherever else, that wine would move to a 0% tariff for a period of 12 months. Now, it's unlikely that that would stay permanently, because it's part of a bartering objective with those third country partners when we go to strike free trade agreements. So it's possible that the government would look to bring those back, but the WSTA will be pushing for tariffs to be removed on wine permanently. As I mentioned, there were no tariffs on spirit imports, with those small exceptions. The rums will retain the small tariff. The US whiskey, because that's a separate issue to Brexit and the EU schedule, that's a trade dispute, that would need to be under review as to what happens with that, and that would also take into account US and EU actions around the Airbus Boeing case, which is currently coming to light as well. So as it stands, we would apply no tariffs to wine imports. Additionally, you might expect tariffs on a no deal if you were to export your wines to the EU. So you would start to pay the EU customs tariff, because on a no deal we would no longer be a member of the EU, and therefore there would be a new border between the EU and the UK, and those wines entering the EU would now face the tariff. That is probably most important for that would be most important for UK origin wines, so English sparkling wines and English still wines probably. If you're bringing wine in from Australia to the UK and you're re-exporting it, it would just be a case of paying the tariff at the EU border instead of paying it as usual at the UK border. You might pay a tariff if you bottle the wine in the UK, so you might move within those tariff brackets, and so you wouldn't be paying the bulk rate as it entered the UK because we'd removed the tariff, but you might pay the bottled rate as it enters the EU. As Sean just mentioned, there is a term in DIT and DEFRA at the moment called trade agreement continuity. So under the membership of the EU, the UK is part of over 40 trade agreements which increase our ability to trade with a number of different partner countries. At the moment, the UK is in a process of moving those agreements from EU third country agreements to UK third country agreements, and they're trying to get as many of those agreements done for exit day as possible. Obviously, exit day is a bit of a fluid moving point at the moment, so if exit day is the 31st of October, not all of the agreements will be in place. If exit day is the end of December 2020, hopefully more agreements will be in place. Currently, there's about 16 of the 40 trade agreements ratified and in place, or approaching signatures for agreement. DEFRA have confirmed the continuation of the US and Australia wine agreements as well, so they're regulatory agreements. They don't deal with tariffs, but they do deal with some of those winemaking practices, labeling issues, protection of geographical indications, etc. So that should all be continued in time for exit. Coverage of about 70% of trade covered by EU third country FTAs within those 16 agreements, but there are some significant ones that have not yet been ratified, and I'll go on to those in a moment and where some of those changes might affect our industry in particular. It would be important for companies in the room, if you're exporting to any third countries, to have a look at the list to see which of those third countries are currently covered by FTAs between the EU and third countries, which of those third countries are on the list of 16, which are not, and which of those countries that you're exporting to you currently obtain tariff-free access and where you might lose it in the future. So that's a bit of an exercise to undertake, but later in the slides I'll talk you through how to undergo that. Some of the terms of trade, as we mentioned, might change, in particular with Canada, Japan, and Mexico, because those three agreements don't look like they're going to be in place for exit day for a variety of reasons, and I'll tell you why in a second. Chile and South Africa have been agreed in principle and signed. They should be available for a day one no-deal exit at the end of October. The Chile tariff should continue to be exempt from wine trade. With South Africa, it's a little bit more complicated because it's a tariff rate quota. It doesn't cover all wine imports from South Africa. The agreement has yet to be published on gov.uk, so that should be done shortly, which will then allow us to see what the final allocation of volumes is for that tariff rate quota. It's meant to be based on historic usage, so the EU have said that they will not be reducing their element of the quota within the agreement, so they will keep the full 100% as it is, and then the UK's new tariff rate quota within the agreement should reflect the amount of South African wine that's coming into the UK under that agreement. So it should be roughly similar access to what we're experiencing at the moment, but we have to confirm that when it's published. So trade agreement continuity, as an example of where there might be a possible change. Some people in the room, if you export gin, you may export it to Mexico, which is a relatively large gin export market for the UK. The current rate for gin, vodka, a couple of other spirits is 0% under the FTA. That will move to a 20% tariff if that deal is not ratified. So on your gin exports to Mexico, and it looks like that deal, it hasn't been done yet. We're obviously running short on time. It's difficult to say whether it will be in place. You might expect to face a 20% tariff when exporting your gin to Mexico. I will show you later in the slides where you can get details of all of the different tariff rates as they would apply. Another example of a possible change is Japan for wines. So under the EU-Japan FTA, it's actually called an EPA, it's an Economic Partnership Agreement. There's currently a 0% tariff for sparkling wines. Additionally, that's self-certified under the agreement. It doesn't quite require the certificate of origin to claim those benefits. It just requires a kind of a filled out invoice designating origin. That will move to 182 Japanese yen per litre sparkling wine tariff, which is roughly about £1 and 5p per bottle. So it's a specific tariff. It's a little bit easier to calculate, but it's not going to do anybody any favours in their wine exports to Japan from the UK. Again, this is for UK origin wines from the UK. It's not a case of if you import a fine French wine and then sell it on to Japan, that is a French origin wine and will still be covered under the EU FTA. Okay, so again, apologies, this is a little bit small, but this will show you what the agreements are that have been agreed. There's 16 of them. We'll circulate a list of those agreements and the link to where you can find the agreements, and that stays up to date day by day on DIT's website. Some of the important agreements in there, as mentioned, Chile, South Africa. In terms of exports, I think South Korea is in there, Switzerland is in there. All of the kind of Caribbean countries are part of the CARIFORUM bloc. There's a number of others. So that is the list of 16 agreements that have been ratified. For day one no deal exit, this is the list of the rest of the agreements that have yet to be carried over. So there's about, I guess there should be about 24 of them. Important within that group is Canada, Japan, Mexico, Morocco, which has a very high tariff on gin. I think it's about 45 or 48% tariff on gin. If you send any exports to Morocco, it's not a huge market, but it does account for about $1 million worth of UK gin exports. So it's worth considering if you are there. There is going to be a significant impact on your products regarding tariffs. So then there will be a change, as mentioned earlier, to how we approach trade with the EU as well in terms of tariff. There's no tariff currently in place on UK exports to the EU because we're a member of the customs union under the European Union. In a no deal, the MFN WTO member rates would apply against wines. Below are the rates for sparkling, still, and still wines in 2 different volumes. There's also slightly different rates for bulk. But the EU Commons Customs tariff for wine will apply to UK exports to the EU. So that will be the 9.90/12 euros per 100 litres of bulk still wine, 13 and 15 euros per 100 litres of bottled still wine, and 32 euros per 100 litres of sparkling wine. So they will come into effect in the day one no deal situation between the UK and the EU. And companies should be aware that if you bottle bulk in the UK and move it on, you will be subject to the bottled tariff instead of the bulk. So in saying all of that, how is best to prepare for these possible changes for your business? You should review the origin of your imports and destinations of your exports. So if your imports or exports are covered under an FTA, make sure you're aware of which FTA it's covered under. It may not be covered under an FTA. For example, there's no FTA with the US, so there's no tariffs applied, or there are tariffs applied to US wine, but the changes are unlikely to be significant. But there is FTAs where there will be an impact, as mentioned, Canada, Japan, etc. Are the origins and destinations of your exports covered by free trade agreements? Will those free trade agreements be in place for day one no deal? You can find that on the website, 16 of them there at the moment. Hopefully that number will go up as we approach exit. If not, will you face new tariffs applied? I'm going to show you a website in a second where you can find out whether those new tariffs will apply to your products or not. Who bears responsibility of changes in tariff costs? This is an important factor for anybody who's exporting or importing, and it really depends on how your contracts are set up and what your Incoterms are. So Incoterms are international commercial terms of sale. They're included within contract. Ones you'll be aware of are ex-works, customs insurance, freight. There's DDP, which is delivery duty paid, or I think so. There's a variety of those Incoterms. You need to look and find out which one is in your contract and how that bears responsibility for payment of tariff costs for your goods. And whether it's with you as an importer or with your trading partner as the exporter, or vice versa in the export situation. So some of those resources, and we will circulate these, the full link to the UK trade agreements with non-EU countries list. The 16 of 40 agreements are there at the moment. It also shows you which ones are not yet ratified. The European Market Access Database is an incredibly useful trade resource that everybody should just go on and become familiar with in itself. We have access to this while we are still members of the EU. It's a good idea to get on there and have a look at it now. I've heard, although I haven't tested it, that it is IP protected, so we could lose access to it as we move out of the EU. DIT are in the process of trying to replicate something similar for the UK system, but it is an incredibly large piece of work. When you go on there, the amount of information you will find, not only about tariffs, but also about rules of origin and all of the documents that you're going to need when you send a shipment somewhere, such as your bill of lading, your invoices, everything else is all detailed on that market access database. It will help you, whether the EU has a free trade agreement with that country or not. It tells you everything you need to do to get your products into that market. So you should go on, have a look. It's done by destination, either origin or destination, as well as tariff code, so you can split it down and find out exactly what you need for sending sparkling wines to Japan under the FTA. The International Chambers of Commerce website, where you can find out what the Incoterms are. So you should become familiar with the Incoterms, make sure that your contracts are up to date, review those contracts, see if you need to make any changes as to who bears responsibility for delivery of the product, who pays the tariff at what stage, and how that might affect your business. So finally, there are tariff rate quotas applied to wine products, not applied to spirits products, because there is no real tariffs in place against spirits, with those few exceptions we mentioned earlier on. Tariff rate quotas allow an allowance of imports that may enter a country at tariff-free or tariff-reduced rate. So they're claimed, I think they're claimed at the border as the tariffs, as the product enters, in terms of, sorry, I should clarify, there are two different types. There's ones included within FTAs, such as the South Africa one, which Ed mentioned earlier on. That's managed by South Africa, as far as I'm aware. The UK and the EU have what's called an ergo omnes tariff rate quota, which is basically available to everybody. So importers from the UK and products that are coming from around the world try to get a slice of that TRQ, because it means your products can come in at a reduced tariff rate. In the event of no deal, the government's committed to a zero rate of tariff on wine for approximately 12 months, so TRQs are not important for those 12 months once that comes into place. But after that, or in the event that we get a deal and exit the interim period, those TRQs come back into play, and you have the ability to claim some tariff-free or tariff-reduced access underneath those. As mentioned, they are available at this link here at the bottom. That will be on the slides, just to give you an idea of what they look like. So for bottled wine in containers holding less than 2 litres, there's 35,000 hectolitres of TRQ available to claim It reduces the rate from 13.15 to 10 euros per hectolitre. And for containers holding 2 litres, more than 2 litres, but less than 10 litres, it reduces that rate to 8 euros per hectolitre, and that's for about 4,000 hectolitres worth of TRQ. So that is all available to claim to make trade a little bit simpler for you, maybe not simpler, but a little bit cheaper in the event of TRQs being in place. So that covers tariffs and trade update from me. We're going to have some questions at the end. We'll be happy to come back and hopefully cover off any questions you might have.